Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Intel.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And definitely check out the VIP Algos link below in the description. It is a really fantastic tool for tracking the exact kind of massive market shifts we're going to talk about today.
Absolutely. So imagine for a second if back in the mid-2000s, Blockbuster had somehow just figured out streaming at the absolute last minute.
Right, like a total Hail Mary.
Exactly. They pivot their entire decaying legacy business model and actually managed to completely dethrone Netflix. I mean, it sounds like an impossible fantasy, right? Like the kind of corporate turnaround that just does not happen.
It really almost never happens. But the financial reports and market models we have in front of us today suggest we are watching exactly that kind of impossible pivot unfold right now.
Yeah, we are looking at Intel's 2026 transformation. Just a year ago, I mean, they were basically being read their last rites by the market, totally written off as a victim of the dying traditional PC industry.
Oh, 100%. They were dead money to a lot of people.
Right. And yet, here we are today looking at how they are suddenly driving this massive artificial intelligence infrastructure growth. So we're going to sift through all the data to show you exactly how this is happening, what the risks are, and what it really means for the future of tech.
And I think it's crucial to ground ourselves before getting caught up in the hype, because the transformation here is objectively historic, but it's an incredibly complex story. We're dealing with unprecedented injections of capital, massive geopolitical shifts, and market expectations that are now sitting just sky high.
So let's start with the fundamental question here. Like, how does a company actually manage a turnaround of this magnitude without just collapsing under its own weight? I mean, a too-big-to-fail safety net sounds nice in theory.
Yeah, in theory.
But to see if this company is actually surviving, we have to look under the hood at the cash they are generating. And the hard numbers coming out of their recent earnings are frankly staggering.
They really are. To validate a pivot, you need revenue, right? And Intel has now logged 6 consecutive quarterly earnings beats. If we look at the first quarter of 2026, their revenue hit $13.6 billion.
Wow.
Yeah, that is a 7% year-over-year increase, which comfortably beats the street consensus of $12.42 billion.
And the adjusted earnings per share just crushed it, too. The street was expecting a measly penny per share, and they delivered 29 cents. But going through the financials, what really jumped out at me is the internal shift in where that money is coming from. The legacy PC business is essentially moving into the rearview mirror.
Exactly, and that is the core of this entire turnaround thesis. Their data center and AI group, the division building those heavy lifting processors for servers, surged 22% year over year to $5.1 billion.
That's massive.
It is. And meanwhile, Intel Foundry, which is the arm of the business that physically manufactures chips for other companies, climbed 16% to $5.4 billion.
Wait, so the foundry business alone is now 40% of their total top-line revenue?
Yeah, exactly. And AI-driven businesses overall now make up a staggering 60% of their total revenue. And that segment is growing at 40% year over year.
So traditional PCs are just not the main driver anymore?
Not at all. The analysts are definitely noticing this structural change. Projections for fiscal 2026 EPS show a jump of 159% year over year to $1.09. Bank of America is even projecting their earnings per share capacity could exceed $6 by 2030.
Okay, let's unpack this for a second, because the top-line revenue growth sounds incredible. But as someone trying to make sense of the full balance sheet, I am looking at the bottom line in these earnings and seeing a terrifying amount of red ink.
Right, the GAAP losses.
Yeah, their GAAP operating losses are still sitting around $3.1 billion. Their quarterly net income is near negative $3.7 billion. So how on earth can a company that is actively losing nearly $4 billion a quarter be considered a financial success story by Wall Street?
It is a totally valid question. And I mean, the answer really comes down to the mechanics of semiconductor manufacturing and the difference between accounting metrics and actual operational cash flow.
Okay, break that down for me.
Sure. So building physical semiconductor chips, building the massive factories or fabs where they are made, it requires unimaginable amounts of upfront cash. The paper losses you are seeing on their GAAP income statement are heavily driven by a massive $108 billion in cumulative capital expenditure depreciation over the last 5 years.
Hold on. Explain that depreciation part. Are you saying the money isn't actually leaving the bank right now?
Precisely. Think of it like buying a $50 million piece of manufacturing equipment. The cash leaves your bank account on day one. But the IRS and accounting rules require you to spread the cost of that equipment out over, say, 10 years.
Oh, right. So you take the hit on paper gradually.
Exactly. So every quarter for a decade, you record a massive loss on paper, even though you aren't writing a new check today. Intel spent a fortune building this infrastructure over the last 5 years, and they are depreciating those costs right now. It drags down the accounting profit, but it masks the fact that the underlying operational cash flow is actually stabilizing.
Okay, I get that. But still, if they spent $108 billion up front, how did they survive that initial vision without going completely bankrupt? Because that is just an unfathomable amount of capital.
They survived because their balance sheet has been structurally de-risked by some of the most unprecedented capital injections we have ever seen. The analysis essentially describes it as governments and corporate entities just backing up the truck to fund Intel.
You're talking about the government grants, right?
Not just grants. The U.S. government actually converted $5.7 billion in unpaid CHPS Act grants, plus another $3.2 billion in secure enclave funds, directly into permanent equity at $20.47 per share.
Wait, so the U.S. Treasury literally owns a 9.9% equity stake in Intel now.
They do. And it wasn't just them. SoftBank added a $2 billion stake.
And then there's the one that really made me do a double take when looking at the numbers. NVIDIA threw in a $5 billion investment at $23.28 per share, which really begs the question, why would NVIDIA, the reigning king of the AI chip market, give $5 billion to a company that is supposed to be one of their main rivals?
What's fascinating here is the strategic necessity of that move. NVIDIA isn't acting out of charity, you know. They're acting out of pure desperation for manufacturing capacity. Right now, TSMC in Taiwan manufactures NVIDIA's chips, but TSMC is just struggling to meet the insane demand from hyperscalers.
Hyperscalers being the massive cloud providers, right? Like Amazon, Microsoft, and Google.
Exactly.
So NVIDIA is physically bottlenecked. Like they have the designs, they have the customers lined up around the block, but they just can't get the physical chips built fast enough because TSMC is completely tapped out.
That's a huge part of it, yeah. The other part is the geopolitical reality. Having the entire world's supply of advanced AI chips concentrated on one island in Asia is now viewed by the tech sector and Western governments as an unacceptable security risk.
Right, the Taiwan vulnerability.
Exactly. NVIDIA needs a secondary foundry desperately, and Intel is currently the only credible U.S.-based source for leading-edge logic capacity.
So if AI is the new oil, Intel isn't just out there drilling for it. They've essentially built the only domestic pipeline, and the government, along with tech giants like NVIDIA, are literally paying them billions of dollars to keep that pipeline open and expanding.
That is an excellent analogy. They have built an incredible geographic moat, but it's backed up by a profound technological moat as well. They are sitting on 13,500 patent families. And outside of TSMC, Intel has the absolute best advanced packaging portfolio in the world, specifically their EMIB and Foveros technologies.
I saw those acronyms in the technical roadmaps. Can you break down what EMIB and Foveros actually do? Like, why does advanced packaging matter so much for AI?
Yeah, so traditionally, if you wanted a more powerful computer, you just made one giant silicon chip. But we are hitting the absolute limits of physics with how big a single chip can get without failing.
Right, they just get too hot or the defect rate goes up.
Exactly. So advanced packaging is the science of taking several smaller, highly specialized chips, which are called chiplets, and stitching them together. EMIB is a microscopic bridge that lets chips sitting side by side talk to each other just blistering speeds.
Okay, and Foveros?
Foveros is even wilder. It allows them to stack chips vertically, like a 3D skyscraper. It means data travels incredibly fast with very little power, which is exactly what AI processing requires.
And the industry is clearly validating that this tech works, given the massive anchor partnerships detailed in the recent data.
Yeah.
I mean, there's the $25 billion Terafab joint venture with Tesla, SpaceX, and xAI.
Massive names.
Yeah. And Alphabet and Google just ordered 3 million custom AI processors, their TPUs, for their 2028 production line. Plus, Intel's Xeon 6 processors were explicitly selected for NVIDIA's new DGX Rubin systems.
And once you start building your hardware architecture around Intel-specific advanced packaging like Foveros, the switching costs to leave that ecosystem and go to another manufacturer become astronomically high. That essentially locks these tech giants into Intel's pipeline for years.
It really completely reshapes how you look at the company.
Right.
But let's pivot to how Wall Street is digesting all of this, because the shifting sentiment is creating some seriously violent market reactions.
The price action has been nothing short of historic. As we noted earlier, the stock bottomed out at $18.97 in August of 2025. From that low, it surged over 400%.
Which is just insane for a legacy blue chip. And in April 2026 alone, the stock ripped roughly 50% in a single month following that tariff announcement with Tesla and SpaceX. The research shows that was its biggest monthly gain since 1974.
Yeah, 1974. It recently hit a 52-week high of $133. Now, it hasn't just been a straight rocket ship. It's pulled back about 17.3% recently to trade around $107, which technical analysts are calling a psychological support floor. But still, the sentiment shift is massive.
Right.
We saw Bank of America issue a rare double upgrade on the stock, moving it directly from underperform to buy and raising their price target from $96 to $135. And there are macroeconomic tailwinds at play here, too.
Yeah, the macro environment. So on June 11th, 2026, the Nasdaq actually rebounded 1.8% overall. The market analysis attributes this to easing rate pressure following a newly announced Iran peace deal from the Trump administration. And just to be completely clear to you listening, we take absolutely no political stance here whatsoever.
Right, just looking at the numbers.
Exactly. We are simply reporting on the macroeconomic market reaction as detailed in our financial data. But when geopolitical tension eases, it often relieves pressure on long-duration tech equities.
It does, but you also have to factor in the speculative rumors that are aggressively fueling this hype right now. There are unconfirmed reports circulating that Apple is in talks for a massive foundry partnership that could generate $700 million to $1 billion in revenue by 2028.
Wow, Apple too.
Yeah. And there are also rumors that NVIDIA is actively evaluating Intel's next-generation 18A process node.
See, I am naturally skeptical of this kind of momentum. A 400% surge in less than a year for a legacy manufacturer? Are retail investors just getting caught up in the FOMO, pricing in unconfirmed Apple rumors as if they are hard facts?
That is the multi-billion-dollar question, honestly, which steers us directly into the bear case and the severe risks outlined in our analysis.
Let's hear it. Because if everything is sunshine and rainbows, the stock wouldn't have pulled back 17%.
Definitely. The primary risk here is the valuation. Intel is currently trading at an eye-watering 141 times forward earnings and 8.8 times sales. According to the valuation models, the stock is sitting 88.4% above its estimated fair value. It is, quite simply, priced for absolute perfection.
Meaning any little mistake is going to be punished severely.
Exactly. Execution risk is paramount right now. We talked about rumors of NVIDIA evaluating the 18A node. 18A refers to 1.8 angstroms, which is an unimaginably microscopic scale for chip manufacturing that Intel promises will leapfrog TSMC. But making chips that small is incredibly difficult.
I can only imagine.
If Intel slips up on the manufacturing yields for 18A, meaning too many of the chips come out defective, or if their timeline is delayed by even a few months, there will be violent multiple compression in the stock.
Okay, let's make sure we explain that term.
Fine.
So multiple compression means that because the market is paying a massive premium like 141 times earnings expecting flawless growth, the second that growth looks shaky, investors yank that premium away. So the stock price could crater from 130 down to 60, even if their actual day-to-day revenue hasn't dropped yet just because the expectation changed.
Precisely. The market simply won't tolerate paying a 141 multiple for a delayed project. And you pair that risk with the ongoing cash burn. Remember, the Foundry division is still losing billions per quarter in actual operations while it ramps up. And their legacy business, the traditional PC chips, is dying.
Right.
Management explicitly guided that PC demand is going to weaken in the second half of 2026, with the full-year PC unit market declining by a low double-digit percentage.
See, here's where it gets really interesting to me. If the PC market is actively shrinking, and the foundry is losing billions while it attempts this high-wire act with 18A chips, then essentially the stock price right now isn't based on what Intel is today. It's based entirely on a leap of faith about what Bank of America, NVIDIA, and the U.S. government believe Intel will be in 2030.
If we connect this to the bigger picture, you are absolutely right. It is a massive bet on the future. But there are powerful mitigants that give the bulls confidence. Yes, the PC market is declining, but AI is decoupling from the PC market. AI server revenue is growing so fast, it's offsetting those legacy headwinds.
That makes sense.
Furthermore, that $12 billion in strategic equity we discussed earlier, that gives Intel an incredibly long runway. They don't have to be instantly profitable to keep the lights on. They have the cash to survive until they reach break-even.
So, synthesizing all this data, the analyst notes, the roadmaps, the bear and bull cases, what is the final verdict?
The final verdict across the models gives Intel an 8 out of 10 bullish score. The consensus is that this is not a short-term flip. The data points to a multi-year horizon, targeting an 18 to 24-month view. The entire goal is to capture the upcoming revenue inflections expected in 2028 when these massive joint ventures actually go online.
And to get there, there's a strict catalyst calendar you need to watch. The immediate hurdle is their Q2 2026 earnings, coming up in late July. They need to prove those foundry losses are stabilizing.
Very true.
But even more critical is the second half of 2026. The analysis points to this as the window for 14A binding customer commitments. 14A is the manufacturing node coming after 18A, and if they can announce that a giant like Apple or Google has signed a binding multi-billion-dollar contract for 14A, that validates the entire multi-year turnaround.
Yeah, that is the ultimate proof of life for the foundry model.
It's an incredible narrative to untangle. You have this legacy giant, stumbling near the brink of irrelevance, suddenly thrust into the center of the global AI arms race, which leaves us with a lingering provocative thought to mull over.
I love these. Let's hear it.
As sovereign governments and national treasuries step in to essentially backstop private tech infrastructure out of pure national security concerns, does traditional stock valuation even matter anymore? Are companies like Intel moving beyond the realm of standard PE ratios and becoming too vital to fail utilities of the AI era?
That is a great question. When a company's survival is deemed critical to national defense, the normal rules of capitalism tend to warp. It's something every investor and tech enthusiast is going to have to grapple with over the next decade.
It really is a whole new paradigm. We hope this analysis helped you make sense of the noise, the numbers, and the massive stakes at play. Keep an eye on those earnings in July, watch for those 14A commitments, and keep asking the hard questions.
And remember, if you want an edge on tracking these kinds of massive tech shifts, definitely check out the VIP Algos link below in the description.
Exactly. Thanks for tuning in to Smart Wealth with Joshua. Don't forget to subscribe, like, and comment, and we will see you next time.